In a week when global bond markets have been anything but calm, one market has stayed quiet. India's 10-year government bond yield has held largely steady, even as yields in several other major economies have been pushed sharply higher. That kind of stability is worth paying attention to. Here is the basic mechanic at work. Bond prices and yields move in opposite directions. When investors sell bonds, prices fall and yields rise. In periods of global stress, like the one playing out now, investors often pull money out of emerging markets and move it towards safer assets. That selling pressure typically drives yields higher. India has not seen that same spike, and the question is why. A few things appear to be working in India's favor. The Reserve Bank of India, the country's central bank, has been managing monetary policy carefully. It is trying to balance domestic inflation against the need to keep the economy growing. When a central bank is seen as steady and credible, it tends to anchor the bond market. Investors do not panic as quickly because they trust the policy direction. India also has a large and reliable base of domestic buyers. Banks and insurance companies in India are required by regulation to hold a portion of their assets in government bonds. That creates a steady floor of demand. When foreign investors pull back during a global sell-off, domestic institutions tend to stay in. That built-in support can absorb a lot of pressure before yields start to move. The stability matters beyond just the bond market. The Indian government relies on selling bonds to fund its spending. When yields stay low, borrowing costs stay manageable. A sharp rise in yields would make that more expensive, adding strain to the fiscal picture. But there are limits to how much insulation any emerging market can sustain. Indian bonds remain sensitive to two forces in particular: US Treasury yields and the value of the US dollar. When American yields rise and the dollar strengthens, capital tends to flow back toward US assets. That pulls money out of developing economies like India, putting pressure on local currencies and bond markets. India is not immune to those forces. It has simply been holding its ground so far. The real test is still ahead. If US yields move sharply higher from here, or if the dollar rallies further, the pressure on emerging market bonds will intensify, and India will feel it too. For investors tracking India's debt market, the number to watch is not just the Indian 10-year yield itself, but how it behaves relative to moves in US Treasuries. That spread will signal whether the calm is holding or starting to crack. This briefing is brought to you by First Financial News. Clear, daily coverage of the economy and markets at firstfinancialnews.com.